You have money in your bank account right now, maybe a few hundred, maybe a few thousand. You worked for it, saved it, put it there. It feels real, it feels like yours. But here is what nobody at the bank ever tells you. That money was probably created the moment someone else borrowed it. Not printed, not transferred from a vault, created, out of an accounting entry, out of nothing. And the entire global economy runs on this. Most people never ask how money actually enters the world. They assume governments print it, central banks release it, and it flows down to the rest of us, clean and simple. That is not even close to what happens. Here is the real mechanism, and once you see it, you cannot unsee it. When you walk into a bank and take out a loan, say $50,000 for a car, the bank does not go into a back room and pull out your $50,000 from someone else's savings. It does not transfer reserves it already holds. It simply opens your account and types $50,000 into existence. That deposit is brand new money. It did not exist 5 minutes ago. The loan created it. This is called fractional reserve banking, but that term undersells how radical the process actually is. Banks are not middlemen between savers and borrowers. They are manufacturers of money, licensed, legal, and largely invisible manufacturers. Now here is where the math gets uncomfortable. When that loan is repaid, the money disappears again, destroyed. The interest stays, the bank keeps that, but the principal you repay essentially vanishes from the money supply. This means the total amount of money in circulation at any given moment is almost entirely made up of outstanding debt. Not gold, not government reserves, debt. In the United States alone, commercial banks have created over $17 trillion this way. The Bank of England publicly confirmed this process in a 2014 report. Not a conspiracy theory, a policy paper, written plainly, read by almost no one. So the obvious question is, why does this not spiral into chaos immediately? Because confidence holds it together. Banks operate under the assumption that not everyone will withdraw their money at once. If 5% of customers want cash on a given day, the bank can cover that. If 40% show up at the door on the same morning, the system cracks. We call that a bank run. It has happened before, it will happen again. And here is the quiet irony buried inside all of this. The people who benefit most from this system are the ones who borrow first. When new money enters the economy through a loan, the borrower gets to spend it before prices reflect the new supply. A real estate developer, a government, a corporation with a credit line. By the time that money ripples through wages and grocery prices, the first spender has already captured the value. The rest of us just see inflation. This is not an accident. It is the design. Now zoom out for a moment. Nearly every country in the world runs some version of this system. The specific rules vary, but the core mechanism is the same. Private banks create money when they lend. That money fuels growth, inflates asset prices, funds wars, builds highways, and quietly transfers wealth toward whoever holds the most debt-backed assets. The reason nobody talks about it is not because it's secret. The information is in textbooks, central bank reports, and academic papers. The reason nobody talks about it is because it's deeply uncomfortable. It challenges the idea that money is a neutral, stable thing you simply earn and save. It turns out money is more like a score in a game where someone else keeps setting the rules. So the next time someone tells you to just save more, work harder, and be patient, ask yourself this. If all the money in the system is someone else's unpaid debt, and that debt grows every single year, what exactly are you racing to catch up to? That question does not have a clean answer, but it's probably the most important financial question most people will never think to ask.